You may have heard the term DTI, or debt to income, referred to more as a ratio, a debt to income ratio. Well, in case you didn't know, that debt to income ratio is very important when it comes to qualifying. So let's take a look a minute at just what the heck a debt to income ratio really is. That's where in loans, we look at the debt we're using in your qualifying divided by the income to determine that ratio. And that ratio a lot of times can determine how much you qualify for. It has to be under a certain percentage, and the percentage depends a lot on the program, the down payment, your credit score, a lot of different factors. But one of the things that you can control as a buyer is just how much that debt is. So what goes into that factor? Well, basically, it's any kind of debt that you have, especially debt that's showing up on your credit report, but debts that don't show up on the credit report that can also be considered in that would be things like child support, alimony, things of that nature. Those factors all go into the debt side of the calculation. And then that is then divided by your income. And that's the income that we're using for qualifying. There's a lot of different factors that can go into that income, just like there's a lot of different factors that go into the debt side of it. So let's take a look at what some of those factors are. A lot of times when we're looking at income, especially when we look at it from the lending side versus you looking at it from your budgeting side, we look at two totally different things. Income you probably look at as well, gosh, this past year, for example, maybe you got a lot of overtime or a lot of commissions, but it wasn't necessarily the same the previous year. Well, we're going to take an average of that income where you may look at it as more like, well, I think it's going to continue, so I'm going to look at more this past year, not the past 2 years. So those debt to income ratios can come out different from a lending perspective than necessarily a mortgage perspective. But that's why it's really important to get a hold of me early in the process so we can look at that. So things you control, of course, is getting a loan. If you're thinking of getting a new car loan, you may want to wait because that debt could be higher than what you're at now. Maybe it's lower. Great things to consider. What would that do to your qualifying? I tell a lot of people, let's take a look at where you're at now and the possibilities of where you want to go, because debt to income ratio is big when it comes to qualifying. So you kind of have a clue now what that debt to income ratio stands for, what it means. The next thing you need to do is reach out to me and call me so we can look at your situation and what is your debt to income ratio, and is there a way to make that better so you qualify for more. So I hope that gave you a little bit of insight into debt to income ratio, and I'll see you again next week.